Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Simon Moon and Max Ormiston of Unicorn Asset Management to talk about their AIM IHT service. Hello Simon, hello Max, welcome to the studio. I guess, Simon, first off, could you give us some background to Unicorn Asset Management and your own experience?
Yeah, of course. So Unicorn's been established since 2000. It's an independent fund management house focused on UK equities. It's a small and mid-cap specialist within the UK. That's an area which we feel is incredibly rich in terms of opportunities. We are stock pickers by nature. Myself, I've been there since 2008, so quite a while. Prior to that, I was an analyst at a private client stockbrokers, JM Fin, and I run the Unicorn UK Income Fund. I'm part of the investment committee. I run the Small Cos Fund, and I've been involved with the IHT Fund since launch as well.
And Max, how about yourself?
And my background, I started in the city at Brewin Dolphin as an investment manager where I worked for 4 years, and then I joined Unicorn Asset Management in 2014, so coming up for 10 years ago now. I currently work as a portfolio manager at Unicorn Asset Management, and I co-manage one of our open-ended funds, the Unicorn Outstanding British Companies Fund, as well as helping manage the Unicorn AIM VCT and the Unicorn AIM Inheritance Tax Service.
So that's what we're here today to discuss. What does it aim to do for investors?
So the Unicorn AIM IHT portfolio service is designed to mitigate inheritance tax liability for investors by holding a portfolio of AIM shares for at least 2 years, which are deemed to qualify for business relief.
And Simon, what are you looking for in the companies you back within this service?
Well, first and foremost, we like companies that are both going to grow and be predictable for us. So all companies are profitable at the point of investment. We like companies that have a quality weighting to them. So you're looking at companies that are well financed, have strong balance sheets with net cash on generally, ones that have a defensible market position or exposed to a growing and healthy end market. So ones that tend to command a really decent return on invested capital or operating margin. So we're looking for high quality small companies that can grow and if they're in the dividend portfolio, provide a sustainable and predictable level of dividend payment.
And Max, is there anything you look to avoid in these portfolios? Any sectors?
So there are, yeah. As a firm, as Simon said, we look to invest in very high quality companies. As a rule, that tends to preclude us from investing in the resource sectors and more cyclical areas of the market, so mining companies, oil and gas companies. And we also don't really like to invest in highly acquisitive companies, which we feel are very high risk. So companies engaged in a buy and build or a roll-up model. We much more prefer simple organic-led growth strategies with companies operating in niche areas of the market.
And you also have some ethical restrictions on some of the portfolios as well.
We do. So in addition to our simple growth and dividend strategies, which Simon's talked about, we also have a responsible portfolio overlay, which is a negatively screened portfolio, avoiding the so-called sin stocks, so tobacco, alcohol, weapons and armaments, which you would typically exclude from an ethical portfolio. So that can be applied to either the dividend or the growth-focused versions.
And so turning to the portfolio, can you give us some examples of recent investments you've made in the service?
Yeah, so a recent investment which we've added to the dividend portfolio, as it happens, is a company called Bioventix. Bioventix is a research and antibodies company. It's a really interesting company producing a sheep monoclonal antibody for use in diagnostic tests. Their primary use at the minute is a blood test to detect vitamin D. So Bioventix produces antibody which is distributed to pharmaceuticals, research labs around the world, and it's truly an international company. They're also investing in a new product which is a test to detect high levels of troponin in the blood, which is an indicator of the potential for a heart attack, and that's expected to be a future area of long-term growth for Bioventix. It's a great business. It's very conservatively managed. It operates with high levels of cash on the balance sheet, is highly profitable, and all of this underpins a progressive and growing dividend yield.
Any other examples?
Another company which we've recently added is a company we know well, and probably investors do. It's Young's Pub Company. We hold this business in our open-ended funds. It's also listed on AIM. It's a very high-quality pub operator in London and the South East. And we've invested in this company for a number of years in our other funds, and have recently added it to the IHT growth portfolio, because we believe there are more attractive levels of earnings growth coming through from that company over the next 5 to 10 years as costs begin to reduce and consumer confidence returns, following what's been quite a tough period over the past couple of years with cost of living, etc.
Very good. And Simon, turning to some of the more established holdings in the portfolio, names you've held for the long term, any examples there?
A very good example, probably the best example of what we like, is a company called James Housestead. And this is a company that makes sort of non-slip flooring, industrial flooring, but it's used in so many applications. It's used in hospitals because it doesn't really have any seams. You can put things down and keep it very hygienically clean. But it's on the floor of trains and tubes. It's within football stadia, shopping malls. You name it. You probably walked over it at some point today. It's been listed for, I think, since before the Second World War. It's had an absolutely enviable dividend record. I think it's grown its dividend every year since 1977. It's got a really healthy amount of net cash on the balance sheet, so that dividend's very reliable. And its products are in international demand, so it sort of manufactures these, but also controls the distribution of them as well. Really high quality end product, great margins, predictable earnings, a very healthy level of dividend payment, which you can really hang your hat on. Just a remarkably high quality company.
And any other examples?
Yeah, so another example, which is actually an interesting company, is called Tracsis. So this is a company which produces software for the rail transport industry. It's a company we actually invested first off in the unicorn AIM VCT at IPO, which was back in 2005, I believe. And we've got to know that business over the past 15 plus years as it's grown from essentially a couple of scientists in a lab spin out of the University of Leeds into a world-leading business now operating in the UK, the US, and other markets. So as I said, it provides software to the rail transport industry. It's highly profitable. It generates large levels of recurring revenue and is we believe, really attractively poised to continue to grow over the next 10 years through agreements with the main UK transport rail operating companies.
Yeah, very good. And so turning to the current environment, obviously I don't need to tell you that it's been a difficult period for the AIM market. How's that affecting your portfolios and the way you invest? So
it has been, as you say, a very challenging period for AIM. I think the peak to trough drawdown on AIM is approaching 50% since September 2021 for the AIM index as a whole. And our portfolios obviously haven't been immune to that. The most notably affected stocks are those growth companies within the growth portfolio where valuations have come under pressure as a result of rising bond yields. And so companies in that service have seen their share prices fall. The dividend-focused portfolio, given its more value-orientated approach towards high dividend stocks, has held up reasonably better than the index as a whole. So that's been an encouraging sign for us over the past 12 to 18 months. But as you say, it's been a tough period for AIM as a whole. But we do now feel that there are the early signs of shoots of recovery coming through in terms of greater level of investor interest in AIM, and perhaps the early signs of a reversal in flows towards UK smaller companies in general.
I'd just add as well, those periods are really difficult to go through on a day-to-day basis. When you're seeing companies very well marked down for sort of pretty spurious reasons that were completely out of their control, primarily down to the way that flows are going into or out of a sector, primarily out of in this example. Within that, there's always a silver lining to that cloud, in that I think about if we look back 2 years to 2021, a significant proportion of AIM companies were trading at a premium to their long-term average. Now the vast majority are trading at a discount, some significantly so to their long-term average, which makes our job really interesting in that we are stock pickers. We go around and find companies that represent not only great stories and very high quality propositions, but also tremendous value as well.
So what are you finding most challenging about the current environment? I guess you've just touched on it.
I mean, there's that in the there's a lot out there to look at. I think the most challenging thing is really down to those underlying flows towards UK equities. They are they are hurting valuations of otherwise very good companies, and that is leading to increased M&A activity, which you might well be the beneficiary of over the short term, but we would all prefer it if these companies were properly supported by asset flows, and that would help keep valuations at sensible levels. So you didn't have, in many cases, rather opportunistic inbound M&A activity, taking out companies that we would like to have in our portfolio for the next our investment horizons 5+ years, and we're getting these companies almost unjustly taken away at premiums to what their share price is, which helps in short-term performance, but not necessarily what we'd hope for those companies in terms of realising the full value that we'd hope to get from them.
Which I guess is part of the green shoots that Max was mentioning. You're starting to see a little bit of M&A.
Yeah, absolutely, yeah.
Yeah, I think the other point on that is that we are also starting to see a return to IPO activity on AIM. It was a very quiet period at the start of 2023, but as Simon said, we've seen companies being taken over on AIM, but we are now starting to see new companies list on AIM as well, and that provides us with a pipeline for new investment opportunities over the next 5 to 10 years.
Which kind of leads me on to my next question, which was, where are you seeing the biggest opportunities at present?
Yeah, so I think generally, as we've talked about, valuations on AIM are in most cases depressed from their long-term 10-year average P/E ratio levels. So as a whole, there are a lot of opportunities at the minute. As stock pickers on AIM, that's really exciting for us. And so what we are looking for are those highest quality companies where we feel share prices have been unfairly punished over the past couple of years, and the company has really continued to deliver on its earnings growth and its objectives over that period. So we are able to add new positions to portfolios in great AIM companies.
Yeah, and when you're thinking about investing in the UK, if you look at where the weight of money is, where the large market caps are, they tend to be in sort of what I would call maybe older industries. There's a lot of mining, there's a lot of commodity focused industries, a bit of tobacco, large banks. When you look outside of that, when you look towards smaller companies, when you look at AIM, there are hundreds of opportunities to invest in growing sectors. Companies are exposed to structural growth themes that are really exciting. So there's a lot of opportunity out there for us, especially at current valuations.
And how risky is it investing in AIM? How do you quantify the risk?
Yeah, so obviously AIM is a high risk market. It goes without saying these tend to be earlier stage companies. As a rule, we don't invest in unprofitable companies. So we firstly look to mitigate some of the risk that way. We invest in more established profitable companies on AIM. And secondly, we feel that by taking a portfolio-based approach, so we hold between 25 and 40 companies within the service, each model portfolio, and that we feel helps to diversify the stock-specific risk, which is obviously one of the main risks of investing in a smaller company.
Yeah, I'd say as well on AIM that the sort of governance requirements are slightly lower than they are on the full list, and I think we handle that risk by meeting all of our investee companies as regularly as we can and making those judgments on the sort of governance structures of these companies. And I think that removes a tremendous amount of sort of broader risk that might be associated with AIM historically.
I guess with the size of the wider unicorn business within AIM, your access to management teams, I'm guessing, should be pretty reasonable.
Exactly. Our corporate access level is excellent. We have the opportunity to meet pretty much any management team we'd like to. We're seen as a long-term supportive shareholder. As mentioned, our investment horizons over 5 years. Much longer if we get it right. As per the case of James Halstead. These companies are more than happy to answer any questions we have. If we have any specific questions that comes around between meeting them twice a year, which we probably ordinarily would do, we can email the chief exec or the finance director, and we get a pretty much instant response.
And so finally, Simon, you get to sum up. For those that want to invest in an AIM IHT service this year, why should they invest with Unicorn?
Well, simply put, I'll start and then Max can finish on this. But the valuation opportunity in the UK at the moment is tremendous. It's excellent for stock pickers, which is exactly what we are. So we are UK only, small and mid cap focused stock pickers. So we put a tremendous amount of work in getting to know these companies and selecting a very select number of them for our portfolios. And we do so with a very unwavering focus on quality companies. So these are companies that we feel are very unlikely to let us down over the long term and very likely to deliver proper, long-term, sustained operational performance. And at current valuations, I think you have a mean reversion of seeing that performance, A, recognised, but B, there might be some sort of re-rating when love comes back to UK equities. And
I think just broadly, Unicorn as a firm, we often don't like to play our own trumpet too loudly, but I think it's fair to say, we should really be considered experts in AIM. We've been investing in AIM since 2000. We run the AIM VCT, which is the largest AIM VCT on the market, and we feel this provides us with a really, as Simon said, excellent level of corporate access, but also gets to know those companies over extended periods of time. So when we do add a company to the IHT portfolio service, we're well adversed with the risks of that business and the opportunities of that potential investment. So that's where we feel we differentiate ourselves from the competition. And finally, I think we're, as a service, we're very nimble. We're not constrained to holding those largest, most liquid stocks on AIM, the likes of the ASOS and Fevertree and Boohoo. We tend to find most of our ideas further down the market cap scale, where as a house we're able to leverage our stock picking expertise and see these better value opportunities.
Very good. Simon, Max, thank you very much.
Thank you.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.